All right, everybody, welcome to another edition of Market Talks with Dr. Stoxx. It is the 14th of January, 2025, and we're going to do something a little different today. Instead of looking at charts and talking about indexes and stocks that I like, either long or short, I'm going to show my chart setup and explain the indicators that I have on there, how you can replicate them and this is for a new service that we just launched a few days ago. And if you're interested in joining us, this is coming to you live from the Dr. Stocks Options Discord room. And if you're interested in joining us, it's an amazing community of traders all interested in trading options. And in that room, we pretty much focus on long calls and long puts. We do some spreads. We might do a put right or a covered call every now and then, but mostly it's long calls, long puts. If you're interested, go to drstoxx.com. That's drstoxx.com. Click on the Learn to Trade menu and scroll down. I'm sorry, not that one. Click on the subscribe menu and scroll down to live options room, and you'll be taken to the place where you learn a bit more about the option service. All right, let's jump over to charts, and I'm going to show you my standard screen. And let me do this with SPY, just a good standard chart to begin with. Actually, I have a bunch of markings on there. Let's go to QQQ. Okay, so when I'm doing my chart analysis, you can see, by the way, it is a gap and crap kind of day. So we had the PPI numbers that came out at 8:30 this morning. They were cool. They were coming in below expectations. That's what the market wants. The market doesn't want to see inflation. The market wants to see not deflation necessarily, but just want to see some expectations missed to the downside. We got it. Everything jumped up. It gave us a chance to get out of some things, but it was a downhill slide from there. And mainly because not anything wrong with the PPI, not anything necessarily wrong with the economy, but we've got CPI coming out tomorrow morning, and the market's a little bit worried about that one. PPI, not as important, the prices that producers pay, not as important as the prices that you and I pay for groceries, rent, gas, cars, and things like that. So the market's worried about CPI. If that comes in, I think if it comes in line, if we just meet expectations, I think we'll see a pretty decent bounce higher. We've got all kinds of reasons why the market should bounce near term before we head downhill again, which I think we're probably going to do by the time we get out to the end of the month and we start getting the big Mag 7 earnings reports. Anyway, I'm going to get sidetracked with all that. Let me get down to business and show you my chart setup. So here's how I have it. I have the daily chart in panel 1. I have the hourly chart, sometimes the 2-hour chart in panel 2. And I have the 5-minute chart over here in the third panel. I'll explain all the indicators I have on here in just a minute, but let me just explain why I've got the 3 panels. So let's say, for example, I'm interested in buying the QQQ. I'm interested in buying the tech-heavy NASDAQ index at NASDAQ 100. I think it's going to do well over the next few days, maybe a couple of weeks. And so I want to do some chart analysis. So I'll go to the daily chart. I take a quick look at it. I'm looking for patterns. I'm looking for oversold, overbought indicators. I'm looking for divergence, bearish and bullish on the daily chart. Then I'm wanting to know if, is it like we're already several hours into the trading day. Has it just been rallying all day? It's going up and up and up. And if it is, I probably don't want to buy it right now. I should wait until it cools off a little bit. Or in the case of today, has it been falling for the last several hours? In which case, if it's getting down to a place of support, we might have a good buy opportunity there. That's the hourly chart, or sometimes the 2-hour chart. I use that to determine whether the stock I want to buy today to hold for the next couple of weeks, is it a good buy right now? If it is a good buy right now, well, maybe it's not a good buy this very minute. Maybe I can wait another 5, 10, 15 minutes to get a better entry. Or maybe I should jump on it right now because it has pulled back and now it's ready to bounce. That's what the 5-minute chart is for. So daily chart, is it a good swing trade? Yes or no? Hourly chart, is this a pretty good time of the day to buy or sell, to enter a new position, to get out of the position? 5-minute chart, is right now the time to get in or to sell, or should I wait? So that's why I have the 3 panels. It's just a matter of timing. And I need to say this too, there are often times when I don't even look at the 5-minute chart. I know I need to get in right now. Maybe it's getting close to the end of the day, or maybe there's going to be some data coming out and I want to get ahead of it, or maybe it's just been, it's just starting to take off and I don't want to be left behind. So I don't even look at the 5-minute chart. I may not even look at the hourly chart. I just jump on. You got to do that sometimes. But in a market that's maybe not real volatile, not moving very fast, it is helpful. You'll sometimes expand your return on equity by timing your entries and exits a bit better using the three charts. So let me do this first. I'm going to show you what I have on the hourly chart because it's a little different. It's the same as the 5-minute chart, but it's different than the daily chart. So I'm not going to explain the linear regression channel on this. I'll wait till we get over to the daily chart. But here's what I have on the hourly chart. I've got a proprietary indicator that is actually free in TradingView. It's called a divergence for mini indicators. If you go to indicators and you type that in the search bar, you're going to find it. And it gives me these green buy signals, red sell signals based on divergence between price and momentum indicators. And there's 6 or 7 indicators in here. I'm not exactly sure how many it monitors, but you can see this one. This was a buy signal with 7 momentum indicators giving us bullish divergence. If you don't know what that is, it's pretty simple. When price prints a lower low, but the indicators print a higher low, that is bullish divergence. The opposite is true on the upside. So here we have bearish divergence. Price is hitting a higher high, but the indicator is not hitting a higher high, it's hitting a lower high. That's bearish divergence. In this case, it was bearish divergence in the money flow indicator. Over here, it was bullish divergence in the same indicator, money flow. Now you can see that some of these signals are very good, right? This is a very good sell signal. This was a very good buy signal, but they're not all that great, right? This buy signal lasted 2 bars and then it was right back down again. This one lasted 2 bars and then was right back down again. So I only use that as a kind of add-on, a kind of confirmation. I very often take trades without a buy or sell signal on it because I like the chart for other reasons. But if I see that signal there, it's like an added confirmation that I'm moving in the right direction. Always good to get into a long just after or on the very same bar of one of these divergence buy signals, and the same is true on the sell side, on the short side. So that's I haven't configured that in any way. I just use the default periodicity for all of that. That's one indicator we have on here. These wavy bands, there's a blue line, a green line, and a red line. These are exponential moving averages set at the 34 periodicity. The 34 periodicity. So if you put on an exponential moving average, do it 3 times, set it to 34 for your look back period, and then you'll have the option in the settings to do one of those bands at high, one of the bands at the low, and one of the bands at close. When you do all 3 of those, right, high, low, and close, you're going to get these wavy lines. I set them at different colors, and they will follow the average price flow. Now, if price is coming up into them from below, they tend to act as resistance, as they did here, as they did here, as they did right there, as it did right there. When price comes into them from above, they do tend to act as support. Not always, but they do tend, like here's a catch and support that rolled right back down again. Over here in the uptrend, you're going to see more areas where they catch and hold as support of the uptrend, right? Catch and hold. A little bit below, but it's still reversed there. Catch and hold, catch and hold, catch and hold on the support side. So I like to use those. They'll give you a visual of whether you're in an uptrend or a downtrend. If they're flowing lower like a waterfall, you're in a downtrend. If they're moving higher, you're in an uptrend. Very simple. 34, exponential, high, low, and close. Now for the stochastics, I've got this on all three of my charts. It is the stochastic set at the default 14 periodicity. I use, instead of a 3% percentage K, I use a 2%. Keeps the lines a little closer. It gives me a cleaner look. I don't know why. No necessary reason for doing that, but I do prefer it. Now I monitor um, the stochastics just as a kind of last step in the confirmation process. And there are plenty of times, when I will take a long trade, but the stochastics are up at overbought levels. I will take a short trade if the stochastics are down at below oversold levels. So it all depends on the other things going on in the trade, whether or not stochastics is going to be a factor. But if you're going long and stochastics are oversold, it is a nice kind of add on to your confidence in the trade. And the same is true, of course, when it's overbought and you're trying to go short. So stochastics, 34 EMA bands, the divergence indicator, that's what I've got on the 5-minute chart and on the hourly chart. Let's go over to the daily chart, and then I'll explain here a couple more things that I have on. Get rid of some of these. In fact, let me hide the divergence indicator for just now, since we're not worried about that. Let's explain the LRC, the linear regression channel. So if you go to indicators and you type in linear regression channel, you're going to see several versions of it, but just the one simply titled linear regression channel, that's the one you want. I put on 2 of those. One of them I set at, I take the default look back period of 100, so I don't mess with that. I don't change that. But I will change the standard 2.0 deviation, standard deviation on one of them to 1.5. When you put the 1.5 on, where are my hands? On top of the 2.0, you get these nice bands, right? You have a salmon band on the lower half of the LRC. Here's your midline of the LRC, and a darker blue band on top. On top of the darker blue band, you have this powder blue band, and below the salmon, you have a pink band. And the mantra in my trading room is always buy the pink, sell the blue. Buy the pink, sell the blue. You know, why is that the case? Well, the linear regression channel looks back over the 100 days of the last trading period, and it measures the trend of this, whether it's a sideways trading range or whether it's an uptrend or whether it's a downtrend. It measures the movement of price both above the mean or the midline and below the midline, and then it sets the 1.5 standard deviation. Those are the 2 darker colors, and the 2.0 standard deviation from that midline. That's the powder blue and the pink. And it has nothing to do with moving averages. It's all about movement up and down away from a mean in the trend, within the trading range. If you've got higher lows, you've got an uptrend. If you've got lower highs, you've got a downtrend. And the linear regression channel will show you that. It will mirror that trend. Well, we're starting to get a little bit of a sell-off here, unfortunately. Market is a little bit skittish heading into tomorrow. Not something we want to see. Let me just take a quick look at where we're at. We've got some good profit on today because we've got some options that are doing really well for us. But the market itself is starting to go red, unfortunately. But I think we're going to be back up tomorrow. I think it's just some back and fill and some discounting ahead of CPI. All right. Linear regression channel. So When price gets down into the pink, as it did here, and it did here, and it did here, and here, if it's in an uptrend, the price tends to bounce out of that and roll back higher, at least back up to the mean, if not all the way back up to the blue zone, as it did here, and here, and here. So buy the pink in an uptrend, sell the blue in a downtrend. Let me see if I can find a good downtrend for us. AMD, I know, has been not looking very good. Yeah, let me get rid of some lines here. My computer's running rather slowly here. Yeah, so here's a good view of a downtrending stock. Here's a good sell the blue, sell the blue, sell the blue, sell the blue. And your target, if you're selling up here in the blue, is going to be all the way down, at least to the midline, if not all the way down into the pink zone. You don't buy the pink zone in a downtrend necessarily, although there are some exceptions to that. And uh, uh, you don't sell the blue in an uptrend. You don't short the blue in an uptrend. There are some exceptions to that as well, but that's the general rule, right? So if you're using the LRC 1.5 2.0 standard deviation, you're going to have buy and sell signals. When you get down into the pink, look for these things, right? Don't just buy it because it's in the pink. Wait for a green candle on better volume than the day before, and don't get in until the high of that green candle gets taken out, which would not happen on the same day of the green candle. It's going to happen the next day. So that's your general rule of trading the LRC. And I think you could probably make a pretty good living just following those simple rules, right? Buy the pink in an uptrend, sell the blue in a downtrend, look for the buy signal, look for the sell signal. All right. Well, that's really about it. Now, on the daily chart, I do have the 200 period moving average, which is the dark green. I have the black 50 period moving average. And then instead of the 20 period moving average, I like to use the 21 EMA. Why? I don't really have a preference for it, but I know I'm in a professional trading group. All of us in the group trade for a living in one form or another. So they're fund managers and they're private traders and they're people that work for prop firms and things like that. Um, I'm just working here out of my own home, so I have the best living I can ever imagine. I just sit here, talk to great people like you all, clicking the mouse all day long and sharing what I'm seeing with my friends. So it's a wonderful life. But in my um, where was I going with that? I just lost my train of thought. Sorry about that. Oh, the 21 EMA in that group. Everybody uses the 21 EMA, and the mantra there is that when the price is above the 21, good things can happen. When the price is below the 21, it tends to trigger a lot of bad stuff. So if you're in the market, you're long, and you're just holding your longs for weeks and weeks on end, and then suddenly the S&P closes below the 21. That's not in and of itself a sell signal, like just go to cash and stay out of the market for a month. No, not necessarily, but it is a flashing warning sign. And if I show you SPY, you're going to see that it happened. It happened on that big red stick. Let me get rid of this stuff. Happened on that big red stick right there. That was the Fed day. The Fed chairman Jay Powell came out and announced that he was lowering interest rates 25 basis points. Everybody expected that, but then he said that looking ahead to the next year, probably only going to give us 2 more cuts. The market was hoping for at least 3. The market sold off sharply on that, and we've been pretty much below the 21 ever since. So this is not a healthy sign. And my map that I set back in mid-December is that we're going to see a very weak quarter one, a choppy, flat, consolidating quarter two, and then we get the rally in the end of the year. And we should get back up to pretty much near or above all-time highs by the time we get out to Christmas time 2025. But I think quarter one is going to be a bit rough. Quarter two, not as rough, but also not great. And then we'll get a nice back end. So we're already setting up for that, right? Mid-December, right about in here, it was right just ahead of the Fed, and we're already starting to price in. I thought we were going to get a Santa rally. I didn't think we were going to see weakness until the first week of January, but it started with the Fed, I'm afraid to say. All right, guys, I'm going to let you go. God bless everybody. Have a great rest of the afternoon. I will publish this video over to the YouTube channel, post a link in the room, and we'll go from there. God bless. Bye for now.